All right, so today we are digging into a really popular trading strategy step by step. This comes straight from the source material by CashFX Empire, and it's called the breakout and retrace. Now, you're going to find it's all about one critical skill: patience. So let's get right into it. So, picture this. You're watching the charts, price smashes through a key level, and that little voice in your head is screaming, "Go, go, go!" The temptation to jump right in is huge, right? But here's the question. Is that really the smart move? Well, this strategy says probably not. And right here, this is the core principle, straight from the source itself. The whole system is built on an idea that feels a little backwards at first. When you see that exciting breakout, your first job is to sit on your hands and do absolutely nothing. It really is all about having that patience.
Okay, so let's really break down what that means. What's the actual logic here? What's the fundamental concept behind waiting for that pullback instead of jumping on the initial move?
Here's the whole strategy in a nutshell. It's a three-step dance. 1. Price breaks a key level. 2. You wait for it to pull back and retest that exact same level. And 3. You wait for a signal that it's going to continue. It's only after all three of those things happen that you'd even consider getting into a trade. So, first things first. Before any of that can happen, you've got to know where these breakouts might even occur. You have to identify the key battlegrounds on the chart that are worth watching. And according to the source, we're really focusing on 4 main areas. You can see them right here. We're talking about your classic horizontal support and resistance levels, price channels, and of course, simple trend lines. These are the zones where we're going to be looking for our setups. Now we're getting to what is maybe the most crucial part of this entire system. It's all about having the discipline to avoid getting sucked into a false move, or what a lot of traders call a fake out.
So, why is waiting so important? Well, the source document specifically calls out stop hunters. These are the big players who might intentionally push the price just past a key level. Why? To trigger all the stop loss orders from traders who went short too early, creating this illusion of a big breakout only to reverse the price and trap everyone who jumped in.
And here's a perfect visual of what that trap looks like. You can see how the price just pokes its head above that purple trend line, just enough to fool people into thinking it's going higher. But then, bam, it fails and snaps right back down. This is the exact scenario this strategy is designed to help you avoid. I love this slide because it puts it all side by side. On the left, you've got the trap, jumping in on that first move. But look at the right, that's the strategy. See the difference? The price breaks, it comes all the way back to touch the trend line again, and then it bounces. That bounce, that confirmation, that is everything.
So you might be asking, how can you tell a real breakout from a fake one? Well, the source material gives us a pretty good rule of thumb. You want to see a significant move. For example, on an hourly chart, a clean move of about 50 pips away from that broken level suggests it has some real momentum behind it.
Okay, so let's recap. You found your level, the price is broken through with some real power, and it's now pulled back into that breakout zone. Now comes the million-dollar question. When do you actually pull the trigger and enter the trade? And here's the critical point. The entry isn't just because the price touched the line again. No, you need more than that. You need a specific, clear reversal signal that tells you, okay, this level is holding and the original momentum is kicking back in. And these are the signals the source tells us to look for. These are specific candlestick patterns that act as our confirmation. Things like a pin bar, which shows a sharp price rejection, or an engulfing candle, which shows a powerful shift in control. These are your green lights. And here's what those patterns look like in the wild, straight from the source material. On one side, you've got a classic pin bar rejection. See that long wick? That's the market saying, nope, not going down there. And in the other example, it's even stronger. You get a pin bar followed by railway tracks. That's a really powerful sign that the level is holding firm. Now, if you want to make a potential trade setup even stronger, the strategy introduces this idea of confluence. It's a simple concept, really. It's just when you have multiple independent reasons to take a trade all lining up in the same spot. Think of it like several different witnesses all telling you the exact same story. And man, this is just a fantastic example of confluence right here. The entry point isn't just bouncing off one line. It's at the precise intersection of 3 different trend lines. And to top it all off, it's happening right at a big psychological round number. That is a high probability setup.
Okay, getting into a good trade is only half the battle, right? Now we've got to talk about how this strategy suggests you manage the position once you're in, how you protect your capital and, hopefully take some profits.
It's
Pretty straightforward, really. Your stop loss is your safety net. You place it just on the other side of that reversal candle that got you into the trade. If price goes there, your idea was wrong, and you get out. Simple. The take profit, on the other hand, is your plan for getting paid. And this system uses a pretty cool multi-stage approach.
And here's that plan. Step 1. You take your first bit of profit at a simple 1-to-1 risk-reward. This often lets you move your stop loss to break even and make it a risk-free trade. Step 2. You aim for a logical target, like the last major swing high or low. And Step 3. That's your home run swing. You let the last piece of the trade run to see if you can catch a much bigger move.
All right, let's bring it all home. We're going to wrap this up by quickly going over the golden rules from the source material for putting this entire strategy into practice.
These are really the keys to the kingdom here. First, always manage your risk. Stick to timeframes of 15 minutes or higher because anything lower can just be too noisy. Absolutely stay away from trading around major news events. And the last one brings us full circle. Be patient. You have to remember that really good setups, especially on those higher timeframes, take time to develop. So when you boil it all down, this whole system really hinges on just one thing. It's not some secret indicator, it's not about drawing the perfect line, it's all about having the discipline to wait for the market to prove your idea right before you put your hard-earned money on the line. And the only question left to ask is, do you have that kind of patience?